Hi everyone, my name is Mark Quinn. I'm a chartered financial planner and tax advisor based in Portugal, and I help expats relocate here and plan their tax and financial affairs accordingly. In this video I'm going to look at the series of changes that have occurred at the end of last year, which has resulted in the cancellation of the old NHR, the Non Habitual Residence scheme, the introduction of a new tax incentivised scheme, and also what it means if you don't qualify for either and you're moving to Portugal as a standard rate Portuguese taxpayer. So with the ending of the non-habitual residence regime late in 2023, a lot of people are confused now as to where they stand from a tax and financial perspective. So what happened is, in October, the Prime Minister announced that with effect from the end of the year, so the end of 2023, there'd be no new applications allowed into the non-habitual residence regime. The good news is for existing NHRs, these changes don't affect you, so you'll still have the remaining years you have as part of your 10-year NHR period left. You'll still be able to enjoy that, and it's the status quo for you. However, when the government announced these changes, they also introduced a series of transitional rules. So if you were part way through relocating to Portugal, so if you could demonstrate, for example, that you were in the process of purchasing a property or had an employment offer or had initiated a residency visa process, and I put the full details down in the description below, but if you could show that you were effectively part way through a move to Portugal, then you could still qualify for entry into the old NHR regime. And that then gives you through the rest of 2024 to finalise that process. So we're still in this transitional window whereby, even though NHR is effectively closed, there are transitional rules allowing you to still get into the scheme for the remainder of this year, i.e. 2024. To recap the benefits of NHR, and I've spoken about this a lot and I've done a lot of videos in the past on this, but just to recap, NHR gives you 0% tax on income and gains, so foreign source income and gains. This is a general rule. There are nuances around these rules, but as a general rule, that's how it works. It also gives you a flat preferential tax rate on pension income of 10%. And also, if you qualify as what's called a high valued activity, so typical examples are architects, engineers, doctors, artists, then you can qualify for a lower employment tax rate of just 20%, which is quite good when you compare that the standard tax rates in Portugal go as high as 48%. What the old NHR regime didn't work for, however, was gains on shares, share portfolios, ETFs, unit trusts, etc. And we found that that was quite common with clients, especially from the UK, who were bringing across share portfolios or ISAs. NHR didn't work for them, so that your gains within those investments would have been taxed at 28%, whether you qualify for NHR or not. And that's a fundamental difference, and the contrast is quite stark with the new regime that they've introduced, which we'll talk about a bit later. So with the ending of NHR with effect from the end of 2023, the government introduced a new scheme with effect from the 1st of January 2024. It doesn't have a name as such yet, so some people are calling it the new NHR regime, some people are saying it's NHR 2.0. But what it's effectively targeting is it's targeting specific types of occupation. So whereas the NHR regime in the past didn't have any necessity to perform any function as such, you could come here as a retiree and live off pension income. Under the new regime, it's targeting people in the fields of scientific research and innovation. So it's going to be, or we expect it, that it's going to be a bit more restrictive in terms of the range or number of people that could qualify under those classifications. However, I do stress that I'm recording this video on 10th of March 2024. it's still very early days. We're just two and a bit months into the new regime, and the finer detail is still being worked through. And we've spotted some opportunities within the new rules that seem to create a window for certain types of people, especially those of you that are still running businesses in the UK, to get into the scheme, even though you might not necessarily be performing work in the field of scientific research and innovation. I do stress that it is early days, so we're still working through the detail and working with tax lawyers to establish the exact nature of these benefits and how it will work. But the important point I want to make is it could be a fantastic opportunity for you while these windows are still open to actually get into the new scheme. The main reason you want to get into the new scheme over the NHR regime is due to one fundamental difference, and that is the fact that all foreign source income and gains under NHR 2.0 are tax-free. Now contrast that position with the old NHR, whereas I said earlier that gains on share portfolios, unit trusts, ETFs, etc., even ISAs would have been taxable. Now they'll be completely tax-free. If you're running a business, for example, in the UK and you're going to sell it, again, completely tax-free here, tax-free in the UK. And there are certain conditions you need to meet to pass those, but it is possible to be tax-free at both ends. So it's an amazing tax concession. The only exceptions to those new benefits are on pension income. So for some reason pension income was excluded and you'll be taxed at the normal progressive tax rates, similar to how you work in the UK, where the more you earn the higher the tax rate goes. So your pension income will fall into the standard tax bands here. The other exception on the new regime is any income from blacklisted jurisdictions will also be taxable. And because it's blacklisted, they're taxable at a higher rate of 35% compared to the standard rate of 28%. I've put a list of the qualifying activities under the new regime in the description below. But what happens if you can't qualify for the new regime or the old regime? Well, you just become a standard Portuguese tax resident. Now, speaking from experience, I've done that. So when I first came to Portugal in 2014, I was an NHR. So my last year of Non Habitual Residence came to an end last year. So I'm now a standard Portuguese tax resident. It's not been a particularly painful adjustment for me. I guess it very much depends on each family's and individual's position. But in many cases, we see clients can restructure their affairs to be either neutral with the UK or even better with the UK. So if we look at Portugal's quick wins, so to speak, there are several. So first of all, Portugal doesn't have any inheritance tax. It was abolished in 2003. It doesn't have any succession tax if you're leaving assets to direct line descendants, ascendants, or between spouses. And it also applies only to Portuguese-based assets, so it's very limited in its application. There's no wealth tax here in Portugal, unlike, for example, our neighbours in Spain. And you can also structure investment assets. So if you're living off investment income, you can structure investments very, very tax efficient here in Portugal, getting your effective tax rates down to, typically between 3 and 5%, depending on the level of growth within the portfolio. Also, we find that income tax payable in the UK and Portugal is broadly similar. So if we look at the top rate of tax, for example, in the UK, it's 45%. The top rate of tax here in Portugal is 48%, so similar. Now, admittedly, the Portugal tax bands do kick in at lower levels, so that 48% tax payable would have been around 75 to 80,000 euros, whereas in the UK you can earn up to 123,000 without paying that top rate. But equally, in Portugal you can submit joint tax returns, which means that you submit tax returns as a couple, and therefore you can use each other's tax bands if one partner isn't utilising their available bands. which is unlike the UK, because in the UK you submit tax returns individually. So let's look at the most common forms of income that most of our clients have coming to relocate to Portugal. Well, some clients are still working, so admittedly it's a small percentage for those still working. Most are living off pension income, investment income, etc. But for those of you that are still working, you're going to be paying tax at the progressive tax bands. Now they start at 14% and they go as high as 48%. So it works in a similar way to how the UK works. The more you earn, the higher your tax rate goes, and you work through different tax levels and bands. If we look at interest income, so interest, for example, on bank savings, cash deposits, in the UK, these will be taxed at your marginal tax rate. So that could either be 20%, 40% or 45%. In Portugal, we have a flat tax rate of 28%. The only exception to that is, as I've said before, if it's deriving from a blacklisted jurisdiction, so Guernsey, Jersey, Isle of Man, Gibraltar, for example, then it will be subject to a more punitive rate of 35%. If we look at the tax position on dividends, so in the UK, we're looking at rates of 8.75% for basic rate taxpayers, 33.75% for higher rate taxpayers, and 39.75% for additional rate taxpayers. That compares with a standard flat rate of tax in Portugal of 28%, irrespective of the amount of dividend. Again, as it applies to interest, if dividends are coming from a blacklisted jurisdiction, again, they're subject to the higher punitive rate of 35%. But we can see that even at the highest level, the Portuguese tax rates on dividends are preferential compared to the UK. Income from pensions, again, they're going to be added to the progressive rate tax bands between 14 and 48%. The only exception to this is that there are different ways of reporting pension income, and some accountants report on what's called the 85-15 principle. So what they're saying is, when you take income from your pension scheme, 85% of it is deemed a return of your capital, whereas only 15% of it is actually the taxable portion of the withdrawal. So for example, if you took €10,000 out in 1 year, you would only actually be declaring €1,500 and adding that to the tax bands rather than the full 10,000. Now this is a grey area and it's open to interpretation, so you really need the guidance of a good local accountant here in Portugal, and if you need any referrals, I can give you a few names. Just get in contact with me. If you're taking income from a trust, again, tax rates can be quite preferable in Portugal. So in the UK, we're looking at 38.1% or 45%, depending on the nature of the income you're taking from the trust. In Portugal, you're looking at a flat 28% or 35% if it's coming from a blacklisted jurisdiction. Just bear in mind as well, if you are taking money from trusts as your main income source, there are very tax efficient ways of getting money out of trusts in Portugal. Again, contact me if you need some personalised advice in that respect. If we look at capital gains tax, or if you're generating part of your income from realising capital gains, in the UK, if you're selling share portfolios, non-property investments in other words, then the tax rates are either going to be 10% or 20%. So the highest tax band will be 20. In Portugal, slightly higher at 20%, 28% rather. The only additional point that favours Portugal rather than the UK is that Portugal still have indexation relief on individual shareholdings. So indexation relief allows you to increase your base cost to allow for the level of inflation over time, which effectively reduces your taxable gain. So again, we have that here if you're selling it as a Portuguese tax resident that you wouldn't have as a UK tax resident. If you're realising gains on the sales of physical property in the UK, then the tax rate rather is 18% or 28%. That's now coming down to 24% as a result of the budget this week. In Portugal, it works slightly different. So what happens in Portugal is you pay tax on 50% of the gain, and that's added to your income. So for example, if you make a gain of £100,000 on the sale of a property, 50,000 of that is added to your income. So in worst case scenario, imagine that pushes you up into the top bracket of 48%. Because you're only paying tax on 50% of the gain, the effective tax rate is 24%. So again, it comes back to being at a similar level to the UK. The one area that Portugal isn't very good for is realising short-term capital gains. So if you're an active trader and you're making frequent adjustments to your share portfolios, if your income exceeds a certain level, around €80,000, and you're selling within 1 year of the purchase date, so if you're making a short-term trade, the tax rate isn't actually the flat 28%, it's actually added to your income, so again it can go as high as 48%. Now there are ways of structuring investment portfolios so you avoid that short-term capital gains tax, so that doesn't need to be an issue if you're taking advice. I just wanted to say a quick note on visas and tax. So a lot of confusion arises around the issues of visas and the interaction with tax. The two are distinct, so you don't really need to be confused as to the tax effect of the visa routes you go down, because they're kind of independent of each other. Again, as with all tax rules and law, there are nuances to that, but the tax position is dealt with separately to the visa position. Again, I just want to finish on a point that I'm constantly talking about, is the importance of planning and the importance of planning early. Try and speak to somebody before you leave the UK rather than when you've already arrived in Portugal, because that will give you the opportunity to plan earlier and use the exemptions and allowances that are available in the UK before you establish tax residency here. And also the goalposts are kind of shifting. As I said, that we now have 3 tax regimes to consider. What may have been good planning under NHR might not be good as a standard Portuguese tax resident. A classic example of this is a sale of one's main residence in the UK. If you qualify for the Non Habitual Residence scheme, or in fact the new NHR scheme, there's no tax whatsoever in Portugal, and because it's your principal private residence in the UK, there's no tax here. If, for example, you arrive here as a standard rate taxpayer, then although there would still be no tax in the UK because you'd qualify for PPR relief, you'd pay tax on the full gains here in Portugal, which could be quite costly for you. So again, it's important to get the sequencing of your move right, and that can only be done when we know what regime you can qualify, if any, and if not, how you structure your affairs tax efficiently here as a standard Portuguese tax resident. As always, I'm always here to help answer any questions. Please get in touch, and I hope you found this video useful. Thank you.